Welcome back. I'm Simon Brown, doing this sixth session of day 2 of the MoneywebNOW Better Investment Conference. Today this session we're looking at investing for fixed income. And I know a whole bunch of you are thinking, fixed income, not interested, you're going to turn off, you're going to go for I don't know, I was going to say swim, but not in this way, that depends, I suppose, maybe where you are. But stick around, because I think fixed income is an important part, regardless perhaps where we sit. Yes, we can look at folks in retirement and say it's a high priority for them. I think it's got space across the broader investment age groups. Certainly we're going to dig into that today and get a sense of it. I'm joined by 2 experts on stage with me. Albert Botha, Head of Fixed Income at Ashburton Investments. Appreciate your joining us. I'm not going to read through impressive CVs. Trust me, they're long, they're impressive, and they're real, but time is always tight. Kelebogile Moloko, CIO and founder of Prowess Investment Managers. Appreciate both of your time today. I suppose let's kick off with Andre. It's to you first, Albert. To you first. It's about wealth creation. It's about capital preservation. Those are the 2 key components, and the distinction there between anything else that we've spoken about today is also that capital preservation.
Well, yes. I mean, firstly, thanks for having us here, Simon. It's probably been repeated at some point during the last 2 days, but the old Buffett rule is that the first rule is never lose money. And one of the advantages of fixed income is that it's a significantly more conservative asset class. It is also part, as you said earlier, of a broader investment portfolio. I mean, it's somewhat trite, it's been somewhat mentioned a lot, but the old 60-40 portfolio that has gained a lot of fame in the US and to some extent is the base for our modern balanced fund is 60% equities and 40% fixed income. So it certainly is an important part of the portfolio, and it's certainly an important part of providing the diversification and by being the safe haven, by being the place where you're less likely to lose money. By being that, it allows you to do other things, and in some ways it allows you to take advantage of opportunities when they present themselves.
You kicked open the 60-40 door, so let's quickly hover there a moment. We'll come to you in a second. It's been a tough year for 60-40,
yes. And
I suppose the argument is the good old-fashioned cliche. You know what? We're not even 6 months into the year yet, and that is but a blink in an eyelid in an investment time horizon. So
I think what people tend to forget, to some extent, I mean, you joked about how fixed income is not interesting at the start, and a lot of attention does get paid to the equity woes, right? But I mean, we've seen in the global fixed income markets, one of the largest fixed income indices in the world is called the Barclays right? Mm-hmm. Barclays Aggregate Index, and that's been functionally in a downwards market from September 2020. Right, it's down 15% up until a couple of days ago. Right, we've seen a massive drawdown, and it's one of the things that has made the last couple of months particularly difficult for investors globally. Has been this movement in almost a highly correlated nature of all asset classes, which has led to the fact that the current drawdown in assets, if you take the drawdown in bonds, drawdown in equities, drawdown in crypto, is the largest drawdown in asset prices and asset value that we have seen in the world in the last 40 years, both in absolute value terms and in relative to GDP terms. It's about 60% of the US GDP has drawn down from the top at the start of the year to now.
I think the only thing's not is gold and oil, and congrats to the gold bugs, and oil, we wish it would draw down a whole lot more. Yeah. Let's bring you into the process. We spoke about it in the intro there. I said, a lot of people think that fixed income is boring and is a retirement strategy. It absolutely is. Don't dispute that. But it's important, we've been talking for the last day and a half at this conference about diversification, and this is an important part of it. And even as a young investor, there's a space perhaps for it.
No, definitely. I think refer to fixed income as a stepchild, right? I think crypto is the popular child at the moment. Everybody understands equities, and I guess fixed income has not really been brought to the limelight, but it's got many benefits, like it has already been alluded to. I think diversification is one of them. capital preservation is one of them. And it's also very agile compared to other asset classes in terms of meeting your basic needs, right? So if you're investing for education or you want to go on a holiday, you know, it can be tailor-made for a specific need at an individual perspective, where you can, you know, draw down income that you earn from any fixed income investing strategy as well. And also from a balanced fund strategy, I think it gives you that risk diversification strategy, right? Because then you can't put your eggs in one basket. So the 40% rule, you can play around with it from even being as conservative, maybe even as 10% to around 40%. So it really has that dynamic impact in terms of your asset allocation strategy.
Does it almost sit within a portfolio? It's not cash,
yes,
but it's near cash in a sense. So earlier I had a panel and we were talking around the distinction between saving, investing and trading. And when we were talking around saving, we were very much talking cash, money in a savings account. But actually some of that cash, the very, very short term, the stuff you might need in a week, keep that in ZAR. But the longer term, my sister's saving for a car or something like that, this can actually fill as a near cash product.
Yeah, you can, because you can look at cash up to about 13 months, which is more immediate needs, but you also have an opportunity to invest in income funds, which can go up to 2 or 3 years, where you can both get interest accrual or income, but also some capital gain within that investment strategy as well. Or you can even go a little bit longer, where you still get interest income, but a lot more capital preservation, right? So maybe you're looking at 5 years to around 10 years. So your investment horizon is very important to actually take into account, and it actually gives you an opportunity to earn higher returns, obviously lower than the equity strategy or lower than, you know, the property market, but still a very nice to have in your portfolio.
And that's a great point, and there's certainly a segment of the population out there who's retired, who's perhaps living off a fixed amount, and they can't take the risk of an equity market. They would would love the return, but simply can't take that risk, and this is then the perfect space. So I take your point of earlier, you know, maybe for some folks it's only 10%, but there's going to be some people out there who it might even be 100, and then of course there's the span in between.
Yeah, definitely. And I think what's exciting within fixed income is that maybe we think around, you know, just a particular maturity point, either it's 10 years or 20 years or 40 years, but there's so many instruments or companies or even government bonds, corporate bonds, you know, state-owned enterprises, that you can even diversify within your portfolio. So where you're diversifying through the instruments that you're building your portfolio through, but it also means that you're diversifying your risk, but you're also managing your return prospects as well within that context. So I think, you know, just looking at the type of portfolios that you can invest in can also better suit your needs as well, to be able to optimize, you know, growth and also optimize interest income.
What are some of the products that would typically be in fixed income? I mean, there might be some cash in there, but I imagine, I don't know, is there some cash in there? I mean, it's going to be bonds and those sorts.
So fixed income spans, it's somewhat eclectic in some ways. It spans everything from what most people are familiar with, which is a money market fund, right? That's kind of where it starts. It runs through the various things that was just mentioned, various types of income funds. It is generally branches into the area that's broadly called multi-asset income funds, funds that are mostly income, but they're supplemented with things that are near income, for example, a little bit of property, maybe some preference shares, some currency overlays. Currency tends to work relatively well across from bonds because they tend to be uncorrelated with each other. But then also generally part of fixed income, but things that people quite often forget about are your credit, your high yield credit, and then everything down the capital structure through mezz financing. Whenever you hear the president get up on the stage and says we need the private industry and fund managers to get involved in funding the country, what he's talking about is fixed income. He's trying to convince people to go, let's build together, let's build projects. He's specifically thinking, especially more recently, of these kind of power projects that's starting to pop up all over the place, etc. Right? So fixed income spans at a complete gambit. Now, for most investors, their needs will be met by some of the products that I've mentioned first, so your income funds and your multi-asset income funds. Most South African investors find their home somewhere in that kind of space, and it's generally where you should start looking. And only if you can't find what you're looking for there, do you start branching out and start looking for alternatives, add-ons, further ways of diversifying your portfolio. But kind of what's called the short-term interest-bearing category, multi-asset income category is probably the areas where you start looking. And then for those that are slightly more adventurous, South Africa has a pretty decent fixed income hedge fund community as well, both QIFs and RIFs. We're not going to spend a lot of time talking about that today, but it's something else that you can also...
Because you've mentioned everything except equity, crypto and gold so far. So eclectic is the word.
So, I mean, the fixed income, the money market category is larger than the equity general category, right? Yeah. It is a massive category. Same thing with many of the other categories. They are very, very large. They don't get a lot of attention because, let's be frank, no one goes to Brian and says, you know what, I bought myself a bond, right? They'll go, I bought myself some Naspers, right? Or I sold myself my Apple share, or Tesla's done very well for me the last 5 years. But no one talks about their adventures in money markets. It's not the way of the world. So it doesn't make the front page of newspapers as often.
And I've just realized I've got a lot more fixed income than I thought because, of course, Reg 28, I've got that little bit at the bottom, which, and I remember going through my statement at the end of, I suppose it was the March quarter, and it's not sitting in rands, it's sitting in a fixed income.
Yeah, no, definitely. I think it's quite interesting as well. I was doing some research a couple of years ago that just in terms of global financial markets, that fixed income markets are actually bigger than equity markets because every government actually funds through the bond market, right?
Sure, of course, of course.
And I think in South Africa over the last 15 years, we've also seen an emergence of credit or corporates coming to the bond market to also issue. So I guess maybe the broader conversation is a lot easier because then you can talk about, you know, maybe I've got exposure to Bidvest bonds or, you know, Mercedes-Benz and so forth. So there's been a lot of growth and there's been a lot of learnings as well. I think it's just more the investors getting closer to the innovation that has actually happened within fixed income. And I think what is topical now, even within fixed income, is actually the ESG investing, environmental, social, and governance aspects, factors that you take into account. Or even investing in green bonds, it's also another factor. Or investing in fixed income, but having an impact in terms of economic or, you know, social factors as well, right? So you'd even find that in typical retail bond funds that you can access in the South African context, that some of the managers are actually investing in underlying companies that has got that sustainability theme coming through. So you can get financial returns, but as well, you know, be relevant in terms of most probably changing the landscape of, you know, where your
returns.
Exactly the point, yeah.
So there is everything except crypto stocks and gold in there and no barrels of oil. Is it? I mean, most of us would think it's going to be predominantly bonds and probably sovereign. Is that even fair, or am I still missing it?
I think to some extent it's fair because when you look at how governments actually structure their budgets, right, there's a very large component that the proceeds that go towards infrastructure development or even funding social infrastructure such as education, healthcare, and so forth. But we've seen, if I talk about the South African context, we've had state-owned enterprises that also issue bonds in the local listed bond market. So most of them have got an infrastructure focus, which has got a social aspect as well. I think what we're seeing globally, and we yet to see from a South African context, is that you also have corporates that might be involved in infrastructure or social industries that would have a positive social impact that will also issue not only in the bond market, but also in the equity markets globally. So hopefully over time, once we go through the current economic cycle, there might be that innovation in terms of companies that are able to access both the listed bond market or even equity market, where there's an opportunity to actually rebuild the economy through companies that focus on such factors. Yeah.
A question from Lelo saying, I'm 22, just started in investing, wants to know about what fixed income is. Keep watching, we're all learning here so far today. How do you utilize it? And I want to add to it, how do you access it? This is this is not something, I mean, I'm thinking there's some ETFs with bonds in them, but they're not fixed income. And I don't want to go too much down that rabbit hole. I'm typically going to approach a financial advisor or financial institution, such as that you work for, and I would then buy the product that way, either on lump sum or monthly.
Yeah.
So I don't want to go into indexation methodologies and replicability today, but you're right, there's not that many, equity ETFs dominate the ETF market, right? And the primary reason for that is it's easier to replicate and it's more liquid. Whereas because the fixed income markets, the indices aren't easy to replicate, and they're not liquid, all the instruments aren't as liquid, it's not as easy to create ETFs, right? So fixed income, basically, just to simplify it down to its bare essentials, is the capital markets providing debt funding, right? So in other words, we are loaning money to institutions in various ways, right? Either you're doing it via fixed interest rates, that's generally bonds. You're doing it via floating interest rates, that's generally called floating rate notes, and it's mostly used by the corporate credit market. And the third way is kind of what's called inflation-linked bonds, and that's also primarily government, right? Now, for someone that's 22, the way that they generally would access the fixed income market would be via funds, right? One of the advantages in this space is that fixed income tends to be relatively cheap to access via funds. There's for example, money market funds. Our money market fund sits in the 20 to 25 basis point range. Many of the other fixed income funds sit 35, 40 basis points. They're not very expensive portfolios, and they tend not to have, mostly, not completely, they tend not to have performance fees, right? Yeah. So the easiest and simplest ways to do that is go talk to a financial advisor, make sure that you've got your risk and your cash flows sorted out, and they can either help you to get access via LISP, which is a list-linked investment service provider, or if you feel confident in your own ability to analyze markets and to look at these products, you can go directly to a Manco. A Manco is anyone like ourselves, asset managers. You can go to the website, and there's normally a way that you can access the funds and invest directly, right? So that's kind of what fixed income is, and two ways to get access, right? We can talk broadly about other ways as well, but for 95% of people, they're going to get access to in one of those two ways.
And then maybe if I can add as well, I mean, it's also very easy, affordable, right? So most of these funds, you would find that they've actually lowered the minimum amount that you can actually invest. You would find that some of them is 300 per month, debit order, like we at around 500, or it can be a lump sum of 5,000 rands, and also easy to withdraw. So if you need it to access your money as well, it's also easily accessible within maybe 24 hours or 48 hours. So there's also that flexibility within the retail space in terms of just being able to invest there.
That's not bad. I remember Eskom bonds a couple of years ago yielding 22%, essentially backed by government. I thought, brilliant, phoned up a bond broker, minimum 5 million. It's like, okay. So that was me. We've been talking bonds, and some folks, I mean, debt, essentially it's debt. And some folks are going to be like, whoa, hang on, debt, this is risky. This is not lending money to a person you just met in the bar or your brother-in-law or something like that. I mean, this is government, sovereigns, it's large financial institutions. And part of what you folks do as the managers of it, you're assessing that risk.
Yeah, no, definitely. I think it's very important to understand that we have what is called default risk, which we need to measure. And by default risk, we look at what is the probability that the entity that we're lending money to is not going to repay us, right? So that is taken in terms of your portfolio construction. It's taken into account in terms of looking at your portfolio risk and also how you structure your portfolio. So we have what we call credit ratings. I guess some people might have heard of it. So a credit rating is actually Standard & Poor's and Moody's. So they would actually assign a level of default risk on a particular issuer or on a government, which it would be sovereign debt and so forth. So theoretically, a sovereign government like South Africa or the US government is assumed to be default free. So they would actually have a AAA plus credit rating. And the reason for that is it's not like governments don't actually default, because they do. We've seen with Argentina years back, Venezuela and so forth, is that because they've got the ability to print money, right? And that's
and
also...
we all know what that means, but
Exactly.
you're 100% right. I mean, they own the printing press.
Exactly.
But you raised a great point there. And I remember digging into the markets in the 80s as I was sort of learning my way around. And during the 70s, we'd seen a lot of sovereign default coming through. We still have it.
Yeah.
But it's a lot less frequent. You mentioned Argentina, and a decade later, they issued 100-year bonds and they were oversubscribed.
Yeah.
That sort of prevalence of sovereign default is not off the table entirely, but seems to be less prevalent.
It is. I think also you need to look at how monetary policy and fiscal policy has actually evolved through the different cycles. I think 2008 was actually a case in point where there were new instruments that were actually used to be able to support economic growth, or even to minimize the risk of default, or even to support financial markets. That quantitative easing came into place. Governments being able to print money. You also had synchronized actions from your central banks and also from governments globally, and some of the agencies like IMF and so forth, the World Bank, also being involved, because then I think managing global risk became a global issue, right? So and also the impact. I think 2008 happened. We realized that when China sniffs or the US sniffs, everybody gets it, right? So I think there's been this overall risk management from a global perspective. And I think that most probably, in my personal opinion, has actually meant that you would have less governments actually defaulting. So
no, I hadn't thought of it that way. I like that entirely. But we've just been talking around the process of buying. A question came through from Andre saying, but how do I buy bonds apart from going to the post office? Those are available,
Yes.
But there's also the nuance, and I don't want to get too much into the weeds here, but if I buy a bond in the primary market, in other words, I buy it directly from the corporate or the sovereign, and I hold it to maturity, assuming no default, I'm going to get my interest every payment, and I get my money back at the end. But as soon as I start buying bonds on an ETF on the JSE or something, then I can have that risk of capital. And probably for most people, the easiest way to get that exposure is going to be through one of these funds, because then I let you folks, the experts, manage it all.
So we've seen an uptick in interest of our own clients looking at buying a single bond. Because you can understand, we sit in front of investors and you explain to them their opportunities and what a 5-year bond is yielding and what a 10-year bond is yielding. And then a client hears that there's a 5-year bond that's yielding 8.9%. And they say, well, okay, actually I want that one. I want that one. How do I get that one? Now it is possible, right? You need to have a share trading account. And a share trader can generally get you a portion of that bond. They can buy it in the secondary market. And as long as you buy that bond and you hold it all the way to maturity, right, whether that's 2027 or 2032 or 2037 or all the way out, the longest African bond is an inflation-linked bond and matures in 2050, right? You are guaranteed by the South African government precise payments on precise dates, and I can calculate those payments to as many decimals as you require. As long as the African government is there and they're paying out the money, you will get it, right? The value of that bond, in other words, the resale value of that bond in the market, will go up and down. In the same way that your house price goes up and down. But the utility that you get from your bond, right, is fixed and predefined and known in advance, much like the utility from your house remains exactly the same, regardless of whether someone pays you less now or more tomorrow and then less the day after that again, right? So I think it is something that people could look into, right? But it is slightly more technical. It is a little bit harder to understand. But it does, for certain types of investors that want that combination of potentially higher yields, but also along with more certainty.
Comes back to that capital preservation.
And that has a, let's say, a slightly higher tolerance for complexity. If you've got that triad of requirements and traits, it might be something you could look into. And it is something that is available. It's not something that only us highfalutin portfolio managers can buy it. You can buy it as well, but it is slightly more technical. And in the same way that, for argument's sake, Bitcoin and those kind of things are more technical to buy. Some people went through the effort of buying those. It did well for some, but did badly for others. I mean, we're not going to discuss crypto in this session. I'd prefer if we don't.
But I like your point around utility. I'd never thought a bond has utility. The utility is steady income stream that I can calculate to fractions of a cent. Viewers out there, remember, if you've got a question, events at moneyweb.co.za. Send your questions through. They will pop up on my phone. We've still got about another 18 minutes, so we've got some time for some questions there. Another key distinction between a money fund, an income fund, and equity is that the distributions are paid as interest, if I'm correct, and that has tax implications. And I don't want to run down that tax hole, but it does mean know that there potentially is an implication there, and perhaps speak to a tax expert.
Yeah, no, definitely you have to. I think simplistically, obviously, if you're an individual, you have to look at what is your marginal tax rate. So that will apply in terms of your interest income. There will also be capital gains tax that will be taken into account. So you also have to look at what that is. I think your effective capital gains tax might be around 18%. Maxes out at some point. But also, I think another area that's not really given attention is that the government in 2018 introduced tax-free savings, products. And that the reason for that was to encourage the South African citizens to save more because of the low savings rate, right? So you can actually invest or save up to 500,000 in your lifetime without paying interest income, dividend income, capital tax, capital gains tax as well. So that's an advantage. You can save up to 36,000 per annum, up to 500,000. So either you're going into the fixed income market or equity markets or any other market, that's also achievable.
Yeah, and that's actually, because one thing I did notice, since the tax-free came in, we've got the interest exemption, which, if memory serves, 24,800 for under 65, 34,500 above. That hasn't changed. And government is now essentially saying, we've given you this new product. And again, as a youngster, I might want to have equity in there. And as I get into my drawdown years, so to speak, I can start shifting that across.
Yeah, and I think that's a very important point, because I think we're focusing purely on fixed income, but also fixed income can be incorporated into a multi-asset class product, or what we call balance funds, right? So where you can have a portion in fixed income and a portion in equities as well. So it really plays a role in terms of your portfolio construction, and you also get the benefits of tax savings within that similar products as well.
Oh, but what is frequency of distribution, or is this going to depend on the fund? I mean, someone out there is saying, you know what, give it to me at Christmas time, or someone else is saying, I need it once a month. I mean, are the funds, would you find a fund, or perhaps you could say, well, a couple of funds that sort of pay at different frequencies?
So money markets tend to distribute monthly. Income funds broadly tend to distribute quarterly, whereas your riskier funds tend to distribute half yearly. Some investors have an interest in getting those types of distributions and living from them, and it's whereas for many others it's a somewhat of a non-issue, right? I think for many depends on the ease of transaction and on the platform that they use. And if you are looking for portfolios that do distribute monthly, there are a couple, you can look at them. But the higher up the risk spectrum you go, the more likely it is you'll find that portfolios distribute only quarterly or only half yearly. Because it's outside of the income funds, there's quite often just not enough either dividends or income to distribute over a monthly period if you're investing in things that don't pay high income rates.
Yeah, but I think, sorry to interject, the beauty of the distribution methodology is that you can also choose not to receive your interest income,
Just
right?
reinvest it straight
And then you
back
just
in.
reinvest it, so you get compounding interest, and your capital value also goes up. So that's another way to actually enhance your returns as well. So it all depends on what need you have. Yeah.
And it is that certainty. It's what we said right up front. I remember it was April 2020. We'd all gone into lockdown. The retail government bonds were suddenly offering 11.5%, locked in for 5 years. And I thought to myself, you know what? Like maybe markets are going to do better. Maybe they're not. But I kind of like 11.5%.
That's very good.
And it was an opportune moment and time. And they still have. I think they're at 9.75. It's that fixed nature of it. Yes, maybe markets do 50 and I lost out, but so far they're down 30. So not so much the case. I have been using money market and income fund almost interchangeably. I suspect they're different.
Yes, they are different, but not entirely different. I mean, there's different ways to structure them. So generally, a money market fund will invest in, opportunities that are 13 months and lower. You generally target, investing in bank deposits. You'll find that the bulk of the destination will be your banking sector, or there might be some corporates, but the credit quality of the underlying investments is very high, right? So meaning that, and that's why it's actually synonymous with capital preservation as well, because then you're taking lower risk. We know that bank deposits are also guaranteed by the Reserve Bank as well. So the risk of losing capital is very, 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 very low or close to non-existent, but it does exist. But it also means that your returns are also lower. But it's better than putting money under a mattress or even putting it in one bank deposit, right? So because you're getting diversification. The income fund, you're looking at maybe close to 2 or 3 years, depending on what type of income fund you're looking at. So it will be a combination of cash instruments. It will be a combination of bonds that are short-term in nature, mostly government bonds. You can include credit, corporate bonds as well. And some income funds can actually go into other asset classes, like maybe preference shares. You can actually look at a bit of, optimizing your returns through going into equities. Some of them might have a global component where you can take a portion, like our income fund. We can take 25% and invest that in global markets as well, in global fixed income. So it also depends on your risk profile. So if you're more conservative, it's important to look at the underlying structure of the retail product that you're buying within the income fund. But the beauty of having these asset classes, components of them within the income fund, is that you can actually boost your potential returns, but you have to be willing to take a little bit of volatility in the short term, within that 2 to 3 year or 4 year period.
I hadn't even thought of the offshore component, and that would give me exposure to. I mean, if you just stay with bonds for a moment, a multiple of sovereign, and then of course the corporates. I was going to say Apple, but they've got more money than most banks, so they probably don't need to borrow. But and of course that again gives me some foreign currency and also some exchange rate risk, I suppose.
Yeah, no, definitely. I think, obviously, if you're investing in global assets, particularly from a fixed income perspective, it has to make sense from a return perspective, but you are taking a currency view. So if you believe that, our currency is going to be weaker, your proceeds are going to be higher than actually investing in the local market, then it actually makes sense to actually go into the global, fixed income markets as well. And with just the growth in emerging markets and access to emerging market assets as well, means that you can diversify. So you're not only restricted to your developed markets like the US or Europe and so forth. There's a whole lot more that you can invest in, because then there's also a play of, is Brazil priced better than South Africa? They're both emerging markets, but if you think you can actually target higher returns from other emerging market, listed bond markets, why not?
Fair point. Nathan asks a question, use fixed income for short-term saving vehicle. I was suggesting up front that this was a possibility. And notwithstanding, I mean, you were suggesting that actually we can liquidate these literally within a day or two. I mean, is that a proper benefit? The problem with money in the bank, as Nathan says, my return is modest. I think my banks, I mean, maybe they're generous and they're giving me 4.5% or something like that.
That's very
high. Banks are restricted from providing high returns on those short-term next day, let's call them the instruments by a piece of regulation called Basel III. It affects how much of their savings and deposits are allowed to account for various types of ratios. Things called net stable funding ratio and all a range of different things that you would need a different masterclass on from someone in the bank to cover. But so they don't generally offer great kind of on deposit rates in that space. And the moment that you then start putting it away for 1 month, 2 months, 3 months, 6 months fixed deposits, then it is literally fixed. Then the rates are higher, but then you can't touch it for 5 years, right? So we find that in many of our products that short-term need, in other words, I'm saving for something like a car, right? I don't know what the car's going to look like, but I'll know it when I see it. In the meantime, I'll save. And then suddenly you look scrolling through Auto Trader, you find the car, you go, I'm buying this tomorrow, I need the cash tomorrow. Yeah. That's the perfect type of vehicle. Then an income fund or a money market fund that doesn't have a lot of volatility is the absolute perfect vehicle for that type of need. The other one is rainy day funds, right? It won't rain for 5 years and then suddenly it storms. That's perfect type of instrument again because you can withdraw the money. So regulatory capital, emergency capital, short-term savings for overseas trips, those kind of things, they work very, very well within the fixed income and kind of income fund space.
Yeah. Or even saving for lobola. You want to get married one.
Yeah.
You don't know when you're going to meet the one, right?
Well, you've met her, you now need to raise the money.
You need to raise the money.
Pay for it.
Exactly.
I want to touch on one of the things that we have suddenly seen for the first time in a long time. Locally, yesterday, inflation, 6.5%. UK, 9.1%. America, 8.6%. So we're seeing inflation rising. We are seeing central banks, I think some of them are a little bit behind the curve. Not our own. I think our own governor is great, but I think there's some banks behind the curve, but we'll leave that aside. But does that simple me says, well, that means I should start getting higher returns out of my income funds as we see rates start to pick up? Is it as simple as that?
Yes and no, because remember when you are saving or investing, you want to be able, you're also looking at mitigating inflation risk, that your money loses value in terms of purchasing power, right? And we know that that's inflation risk. So if inflation is at 6.5 from a local perspective, how much are you earning on your money market fund, right? If you're earning below 6.5, it means that you have a negative real returns. Your money's not going to work for you. So generally what the market does is that investors now demand higher rates because of inflation going higher. So you'll see the money market curve adjusting higher, the bond yield curve also adjusting higher. So investors will actually be looking for higher returns. So on that basis, you should be expecting to earn a lot higher, but also you need to look at what is the rate of inflation, because just getting higher nominal rates, which is what we get it, is not enough. It makes sense in the context that you're actually covering the loss of monetary value as a result of inflation.
Yeah. My friend in the UK earning 8% thinks they're winning. Inflation 9.1, sorry for you. It's not quite working. Well, you mentioned ESG earlier in the conversation, and ESG is a weird one. It certainly has been coming to the fore. There's a lot of pushback in terms of greenwashing and concerns and the like. But, environmental, social governance, I don't think anyone can say that those aren't important. I think they're going to become only more important as time moves on. And I imagine that there are components or even, perhaps funds which have higher ESG, higher green credentials for those who are looking for good as well as profit.
Yeah, I think, over the last, I would say, I started Prowess 13 years ago, and back then we were very much involved in, the projects within the industry that we were trying to engage with retirement funds and investors on incorporating ESG factors into your investment strategy, into your investment philosophy, and also into companies that you're investing in, holding them accountable whether they are actually implementing ESG strategies within their corporate strategy or business strategy, right? And I think the philosophy there is that if you do that, you become a sustainable company. You have corporate, citizenship responsibility as well, which is very important. You do well for society. I think that's an overarching thing. But when you think about it, it should already be incorporated, right? So I think there's been a move of rewarding those companies that actually can demonstrate that in their business strategy, they actually incorporate ESG investing. And some investors actually price for it. It's easier in the equity markets. I think when there were oil spills, you've seen that, equity prices got knocked because investors were worried about the environmental impact. From a South African government perspective, we saw in 2015 when we started having governance issues from from a government perspective, that our bond market sold off. So there were governance issues that were coming through. The state-owned enterprises, when there were also governance issues, we saw a lot of local institutional investors also selling your Escoms and other state-owned enterprises. So we're seeing decision makers really taking that seriously, and also being able to price for it where possible. Then it does impact your ability in terms of earning higher returns as well. But it's not a direct correlation because not everybody has yet bought into it in terms of how they manage their portfolios. Not every corporate has bought into it in terms of how they manage their business strategy. But it is a very topical theme. Yeah.
We'll get there in time.
And it's hard. It's harder in fixed income than it is in equities, because we don't have the capacity to vote.
Yeah.
Right? Equity holders vote at annual shareholder events, and they can vote directors, and they can. So we can ask the same questions, right? And we can request the same meetings, but we don't have the right to upvote and downvote various things. So your control is more difficult, and it's more via the funding channel. That's the one thing. And the other thing that's an issue within ESG, within countries like South Africa, I think that is not as prevalent if you read the research internationally, is that people tend to forget that, specifically in developing countries, there is an entrenched conflict between the social and environmental quite often, right? I mean, if you think about let's say a massive new coal mine and if we create a new project, right? We build a coal mine, we build a rail track, we build a harbor, right? It's not very pretty, it's not very environmentally friendly, but it will be amazing for the communities and amazing for jobs, right? So it's exceptional from a social, right? And it could be exceptional from a governance perspective, right? But environmental scores, people are going to look from offshore and go, but that's a bit dirty. And the feedback you kind of want to give them is, yes, but that's the same way you developed your countries. And to some extent, many countries, and Germany's found themselves in that place. They've just moved their dirt off their balance sheets. It's why Germany's suffering at the moment, because they've moved their oil and gas to Russia, and now all of a sudden that's come back to bite them.
And now they're reopening.
Coal.
Dirty ones. But I particularly like your point. I mean, America basically chopped down their forests, and it's why the phrase is a transition, rather than a complete and absolute. A quick last question, because we've hit time. How do I pick the fund? I mean, is this something, and it's, I think I've got a level of skill in equity, and I'm not so foolish as to think I'm the best, but I got some level of skill. In this space I haven't. Is this something where really I should get an expert to assist me? Because I can look at yield, but I know that there's more to it than just yield. Get an expert.
No, I would say get an expert, but also know what your investment needs are, your investment horizon. Am I investing over a 12-month, 2-year, or do I have time? That will determine which type of product to actually invest in. Do I have immediate needs? Like it was mentioned before, I want to save towards something.
Have I met the lady, or have I still got to meet her?
Exactly the point, right? So I think that's where to start. But I think if this is your first time, rather talk to an advisor, and through that it'll be an easier journey going forward in terms of how to navigate it.
And also we run. I think 6 different funds that has the term income in it, right? Income doesn't mean income in the same way, right?
Gotcha.
The one income fund I've run for over a decade hasn't seen a negative month in 12 years. The other fund is sometimes sees negative 2%, right?
Yeah.
Both are funds well suited for their purpose, but just because something has income in the name doesn't mean you can compare it with something else that has income in the name.
Yeah, exactly.
I would highly recommend, if you ever want to use an income fund, look at a performance chart, not just a performance table, a performance chart of the last 3 years. And you can start it in middle 2019 and then just see what it did over the last period. Because a lot of funds did very well over that period, right? Including, but the rides in for certain funds were rougher than others. That doesn't mean that they were poor funds. It's just that they are more or less suited to certain types of environments.
Yeah. Now, and we had Craig John yesterday, and he was saying that's what he does. He starts with the universe of 2,000 and narrows it down to 35. That's his skill set. So I go to him and say, can I have a look at your list type of scenario and get the expert. I like that point. 12 funds with income in the name. That would boggle my brain. We're going to leave that there. We have run out of time. I really appreciate the insights. This was a huge amount of fun. I learned a ton. I hope that you and the audience learned a ton as well. Remember, we're taking a short break now. We'll be back at 1:30. So don't go anywhere just yet. We've still got a number of great shows coming through.